For more on this, Steve Kyle, professor of macroeconomic policy at Cornell University in Ithica, New York. Good to see you. Thank you for joining the show, sir. Are you happy?
Well, yeah, I guess so. The Fed did what everyone expected them to do, and certainly markets like it when the Federal Reserve does what they're expected to do, and they sure made sure that this was no surprise to anyone. I have to say, though, that the Federal Reserve, given its mandate to keep growth going subject to not sparking inflation, really could have gone either way, to be honest. There is no sign of inflation in the data. So they did this more as a matter of psychology, I think. People would have taken it as a sign that the economy was somehow sick or on the edge if they had not raised interest rates. And I think the Fed is anxious to have things back in a more normal situation, and zero interest rates certainly are not that.
See, the way I look at it is we lowered rates, United States, because things were very bad after the financial crisis, right? So I think of the low rates as sort of a drug, if you will, you get in the hospital when you're not feeling well. We've been on this drug for so long. And there is a danger that if you're on the thing too long, that it's going to make you sick. So what it's intended to do is make you healthy. But if you're on it too long, and Janet Yellen has to be a little bit worried about a potential hangover. I mean, how much does that play into it?
Well, yeah, it does. And the thing of it is that while in normal times, in past episodes of Fed tightening, they waited until they saw inflation actually start before they tightened, this is not normal times. And they don't want to wait and be surprised by the reaction of the market if they have to do things more quickly. I think that it is not normal to have zero interest rates. But what normal is going to be from here on out is not entirely clear. They are, to some extent, feeling their way. And I think for that reason, Janet Yellen is completely right to do it very, very slowly.
But the text also says that they're going to raise it to 1+% by the end of 2016. So they've told the market what they plan to do. Now they got to do it. Are you happy with that direction?
No, they don't got to do it. They do make an estimate. You can see points on a chart where the different members of the Open Market Committee say where they think interest rates are going to be 1 year out, 2 years out, 3 years out. And they did say that they expect them to rise 1% a year, more or less. But that's not written in stone. If the economy does head south, they can pause. They can even reverse course. We, in fact, saw the Europeans do that a few years ago. So it is not actually a contract written in blood, as it were.
We talked earlier with Jessica about the rest of the world, so to speak. They were so worried. We've seen commodities all over the place, oil, and there's a lot of reasons for everything, but there was an awful lot of worry coming into today. Should we still be worried?
Well, I don't think 0.25% makes a huge difference as a matter of arithmetic to the cost of borrowing or much else. But it is a change in psychology. I don't think that it fundamentally changes any worries people may have had about Brazil or China or India. Those economies are still in the same state they were a week ago. But it is a good thing that the United States looks healthy enough that the Federal Reserve felt able to start returning to positive interest rates as of now. That has to be reassuring to everyone.
Not to get too technical, but there has always been this concern that the U.S. dollar is too strong. So we raise rates. That makes the dollar, in theory, stronger compared to other currencies. The rest of the world still has low interest rates. Is there a danger that we keep raising rates and we ended up making the dollar so strong that it ends up hurting companies?
Well, yeah, it'll hurt some and help others. Certainly, the United States has been in the position of sucking capital in from the rest of the world whenever everyone gets nervous. And even if the source of the problem is the United States, as it was in 2008 and 2009, paradoxically, the dollar rose even then. So we could see that kind of thing happen. But I think the dollar is already quite strong against the euro, against the Asian currencies. And so I don't think this is going to make a huge difference. But you're right, it does, if anything, at the margin, help the dollar to strengthen.
All right, interesting discussion, Professor Steve Kyle. Good to see you, and thank you. Thank you for your analysis on this.
Thanks for having me.